So to start off, I provided just a brief kind of introduction of both of your roles, but I'd love to just, for the audience, can you just talk to us a little bit more about yourself, introduce yourself and your role at CIBC? And Joe, I'll come over to you first.
Yeah,
good to
thanks,
see you.
Erica. So I would start off only by saying Daniel's slides on the private equity markets are super relevant to the debtors. The debtors, like my own company, CIBC, we tend to work pretty closely with the private equity folks and the venture capital folks. We've got $500 million of LP commitments, out into those folks. That's where we get a lot of our deal flow from. And I would say that in the current market, the bet increasingly is, can you get cash flow break even? Whereas a year ago or 2 years ago, the bet was always, can you raise more capital? And so, the markets for, equity and debt have sort of swung back to, a bit of a Rule 40 game. Anyways, CIBC, my role at CIBC is I run the technology practice in Western Canada for the commercial banking team. My group was built on the foundation, a chassis that the bank acquired 4 or 5 years ago called Wellington Capital. They were an LP-backed debt fund. The bet, and I think a pretty good bet the bank took, was they didn't have DNA inside the bank to go do what we're doing. And so they acquired it and hired it to get enough tech DNA in the bank. So I'm pretty typical of folks in my group. I did 20 years of venture capital, first with BDC. I was hired by Brent Holiday and Rich Osborne, folks you guys might all know. They're Garibaldi, and Rich just left TELUS to do his own thing to raise a new fund. And we do 3 types of deals, essentially. We do traditional bank deals. You're raising capital, you want a line of credit, you need a bank, you want to do Forex, you want to grow abroad. You need a bank. The second type of deal we do is, growth, acquisition. We work alongside the private equity folks and the VC folks, and we capitalize your company over a period of time. These deals can be as big as 50 or 100 million. And then thirdly, we do majority and minority recaps. So your cap table needs a bit of cleanup. You bring in a partner, they buy a position in your company. Some of the money goes maybe to your balance sheet, but some of them goes out to shareholders that are no longer with the company. This is a set of activities we really like. And we've got operations I've got peers in every major tech market. We've got them in Austin, Silicon Valley. We've got them in Chicago and New York City, Virginia, Toronto, Montreal. So we really are a cross-border bank. We can issue accounts natively in the US. We can do it here. We can even do it in the UK where we have a team. So as your company grows, we can sort of grow with you. And so, and most of the people in my group have been around for quite a long time and seen a couple of cycles. So the stuff that Daniel's pointing out, we saw 10 years ago, we saw 20 years ago, but it's pretty darn scary for the folks that are seeing it first time today.
Thanks, Joe. Daniel, after that great presentation, I'll go back a step, and I'd love to just hear more about your role and at CIBC.
Sure. So I've been a technology investment banker for about 15 years or so, and my focus really at CIBC is advising companies, I'd say in size, they tend to be anywhere from about 10 million in annual recurring revenue to about 30 million in annual recurring revenue on M&A, so mergers and acquisitions, both on the sell side and the buy side, as well as recapitalization. So, shareholders need some liquidity and are looking to take some money off the table, or growth equity raises. So not talking about sort of seed or Series A type deals, but situations where a company is looking to raise 50, 100, $200 million in the private markets. Oftentimes, we're advising on what's called dual track processes. So the company has hit an inflection point in its evolution and could look to sell the business, could look to do a private equity backed consolidation play, which means they'd need to switch out some of their existing shareholders, or they're looking to raise another minority growth equity round. And oftentimes, the boards of these companies aren't quite sure which path to take. And so our role is to get as many options on the table, get the best deal terms in any situation, and then let the founders and the shareholders decide on which path is best for them going forward. About half our practice is advising venture-backed companies. So, fun fact, before Joe and I both joined CIBC at the same time 5 years ago, Joe is probably one of my best clients as a VC. And so
yeah, we were quite shocked to show up on the same call the following morning. We both changed labels.
That's amazing.
And then the other half of the companies that we represent are bootstrap companies who have got no VC involvement at all, really.
Excellent. Well, great. Well, I'm so pleased to have both of you here. I know CIBC is such a great partner of BC Tech, and you always come and support us for our Technology Impact Awards, and you're such an excellent resource for us today. I know we have lots of our startup members on the call, and companies of kind of growth and scale sizes as well. So you guys are going to be an excellent asset. As I mentioned earlier, we called this session the ABCs of tech deals, and obviously kind of referring to Series A, B, C, even D, E rounds before a company might consider an exit or an IPO. So I'm interested to get your opinion on that journey that many founders are navigating. So how long and how many rounds does it take to get to an exit? And should founders be building to sell or looking for an IPO? Or looking at that dual track, which I think, Daniel, you had mentioned. So curious to get your input on that. And maybe I'll get Daniel to weigh in first.
Sure. So an exit in my mind is really a sale of the company. I don't actually think of an IPO as an exit. I think of it as more of a funding event, but I'll certainly address both. And my perspective on timing and the number of rounds to an exit or an IPO is that it's largely dependent on how capital efficient you are. And to some extent, this is determined by the business model that you're executing. Vertical market SaaS companies can scale really quickly with just a seed or Series A, or even completely bootstrapped. And Jane App in BC is, I think, a really good example of this. Whereas companies who are building new categories altogether, and I'll cite a couple of other BC names like General Fusion or D-Wave, could require multiple rounds of investment, totaling hundreds of millions of dollars before they're in a position to look for an exit or an IPO. Now that said, I think there are general rules of thumb that we can look to. In regards to a sale, it can really happen at any point. Earlier stage companies who've just raised a seed or a Series A can often be product or talent acquisitions for larger companies. And then for companies who are interested, for companies to be interesting to a private equity buyer, the threshold is generally around $10 million in annual recurring revenue. And then as you think about an IPO, I'd say you'd probably want to target at least a $1 billion valuation in order to attract the level of liquidity you're going to need to garner all the benefits of being a public company. And of course, the valuation multiple applied at the time of IPO will be a function of the type of business you're in and your comparables, as well as what the market multiples are at the time. And then finally, should founders be building to sell their companies for an exit, for an IPO or a sale? I don't think founders should be building their companies for either a sale or an IPO. I think founders should be building companies because they're passionate about solving a problem.
Yeah, I would certainly echo that. Is at the end of the day, at any practical level, you're always selling bits of your company, right? You're selling, warrants to attract the next employee. You're selling, you're giving away maybe options to, some of your partners. You are, building for the next round, and ultimately you may, in some sort of abstract, be building for exit or IPO. But I think all those things line on the same continuum of excellence and data-driven excellence. And so, the best entrepreneurs I've ever met never built for the long run. They built for excellence and created optionality at each point, where they could, raise or fund with banking debt or take an IPO or sell to a strategic. Those things all come come around to companies that are built on quality.
That's great. That's great. It was a bit of a trick question for you both there. But next, I kind of wanted to dig in, and maybe this will connect back a bit to your opening presentation. But given that kind of current market that we're sitting within, what kind of factors does it take to get funded? And that might be kind of stage specific, but maybe just, you guys mentioned earlier the rule of 40 applying more now than more than ever. So what does it take? And Daniel, if you could maybe comment on this first.
Sure. I'd say in 2020 and 2021, and maybe I'm exaggerating, but if you had a pulse, I'm kidding, of course.
Of course, you didn't need a pulse.
It was all about experimentation and blitz scaling. How and investors were looking at, oh, what's the TAM? What percentage of the TAM can we get? It became very much top down. And people were funding ideas. They were funding a thesis. They were funding an idea, and you didn't need a lot of traction. You didn't need a ton of product market fit, as long as you could sell the idea. And the other thing about back in sort of the heyday was that closings were really quick because of the level of competition. Investors just didn't have time to do a ton of the DD that maybe they ought to have. And you can see the results of some of this now. FTX would be a good example, right? And the other thing is that investors who had very, very big funds who were looking to deploy, they were pushing companies to spend more than they even could, right? Like we've got clients who, and I won't name the investors, but some of the investors would come to them and say, hey, we really like your company. We understand you're looking to raise $20 million, but our minimum check size is 100. Can you find a way to spend $100 million? And so it was like, well, I guess we could host an annual event, and maybe we'll get the Foo Fighters to come out and they'll play at the event, and that should take care of a few million. That was kind of the environment we were in, and I'm not really exaggerating. And I'm sure many of the companies within the BC Tech Association have some experience with this. Now that's just completely flipped on its head. It's about capital efficiency. It's about being able to do more with less. Product market fit is really important now. It's product market fit just means you've got a product that the market actually engages with over the long term. People use it, they get value out of it, and as a result, it's your unit economics look better, your retention is higher, and so on and so forth. And then the other thing is just to be prepared for longer diligence periods. Investors are going to take their time now that they can, and they ought to. I mean, we're investors in a bunch of venture funds, and we hope they're taking their time to do their diligence before writing checks of millions and millions of dollars into companies.
Absolutely.
Yeah.
Thoughts?
And I was going to say it plays right into the hands, I think, of many of the entrepreneurs on this call. I'm guessing it's a very data focused thing now. The due diligence processes, both by the banks and by your VC partners and your private equity partners. You're going to do a deep dive on your churn metrics. You're going to need to know your cohort churns, your logo churns, your net churns, your gross churns. You're going to really need to explain and segment out your growth dynamics by SME and enterprise, or however you do it in your own individual company. This is going to be the big conversation you're having. I think you're going to need a story nowadays about whether you could or should get to profitability on the gas in the tank you're trying to raise. I don't think that all companies are going to, by any stretch do that. But I think that, increasingly in this market, people want to know, how you're going to close at least the gap on your burn to some, rational level. It's going to be hard to raise money super early stage. I think you're looking at love money, in the really, friends and family rounds at the very early stages. Take all from your customers you can, set up your contract so it's up front if you can afford it. The best time to raise is when you've got a stable of, if you're an SME focused company, you're not going to have a stable of name brands, but you're going to need some diversification in that, revenue stream, and build some actual credible metrics off it, your churn metrics and your growth metrics and whatnot. Yeah, you got to do more with less, I think, in this environment. The banks are here, like RBC and us and a bunch of the other banks are still super committed to the tech space. We're not going anywhere, but we work more closely with the VCs and the private equity customer, our partners than ever. And so it really is a group, coming together to fund a company nowadays. And so it is a longer process for sure, as Daniel says.
Got it. And I'll just do a reminder to the audience. We'll have some time for Q&A a bit later in the session. So feel free, as we're chatting here, if there's any questions that come up that you want to raise, drop them in the chat. If you want to just put a note in the chat and we'll come to them near the end of the session. So feel free to drop them in them as we go. So coming back, we've been kind of talking about startups a fair bit, knowing that we have many in our audience today. So I want to get your perspectives on seed rounds and at what point a startup should start looking at potentially doing a seed round. What does that typically look like in terms of dollar value and what they should kind of look for in that funding? So if I could get your perspective, Joe, I'll come to you first.
Well, so I think you should be networking from day one, and I think the day of being able to send a PowerPoint deck over to some financiers is over, and so I think you should be taking all the meetings and all the advice from everyone you can possibly take at the earliest stages. If you've got some peers that have raised money, seek an intro to those money, even on just a social basis. Hey, I'd love to get some feedback on what I need to get to be interesting to your fund, or you need some friendly intros, and you need to get in front of folks, and you need to get some feedback, and you could see folks like me and Daniel, or you could get folks in your own network. But it's never too early to start thinking about capitalizing your company and getting some real feedback on what that's going to take. It's moving with the market, so you've got to do it in real time, and you got to do it frequently. And it's a challenge. It'll be one of the big challenges outside of the company. It's the biggest external challenge you'll face, other than getting customers on board.
Daniel, your thoughts?
The size of the seed rounds generally depends on the market, I think. Prior to 2020, check sizes were in the hundreds of thousands, like 500,000 or $1 million was a good seed round. And then during the peak a couple of years ago, seed rounds got millions. Like there were seed rounds of $2 to $5 million. And that was just a function of the amount of money sloshing around. There are a number of active seed investors, particularly in Canada, who've recently raised funds that were way oversubscribed that I think companies could look to. Some of the names that Joe and I would be more familiar with are groups like Panache, as well as Version 1 here in, well, I'm not in Vancouver, but over there in Vancouver.
Yep, Yaletown in Calgary has a seed initiative. There's a number.
Great.
Yeah, actually, I'll add one more thing too, Erica, is there's a lot of professional folks that are quite focused on the really early stage companies. You're going to need a lawyer, and a very credible place to start building your network is through your lawyers. And so the folks at Oslers and Faskins, for example, do a lot of company side transactions. They know all the VCs, they know all of us, the bankers. So there, you're going to need someone to look at your financials at some point. It's never too early to start these third-party sort of relationships that also are great avenues to a massive network in the funding space.
That's great. Thanks for the shout out to a few of the folks we have here in the audience. And just to,
I hope I didn't forget anyone.
I see Mike from Baskins.
Yeah, good. Yeah, and the BC community is unusually approachable. At least that's my experience. Is they want you to succeed. They're willing to know you for years before you might become relevant to them. I do encourage everyone to get out to the BC Tech events and things like that for sure.
That's great. So my next question is just kind of carrying on from what we saw, in terms of that change we've had from the high valuations to lower valuations. Do you have any advice for startups on how they can maximize their valuation potential? They're going to all kind of wish they could go back in time potentially, but given today's market, how can you maximize your potential? And Daniel, maybe I'll come to you first.
Sure. So I think what you're solving for in valuation is really dilution. And there are general rules of thumb regarding dilution levels associated with different rounds. Seed and Series A investors generally want to own roughly 20% at the outset, as they expect to be diluted in future rounds. And as you move on to future rounds, those investors expect less and less. But with valuations lower in the market, this means that the amount of capital you can raise for any given size of dilution is going to be it's going to be a smaller raise. And so, given some of those target ownership thresholds, if you want to maximize valuation, what you need to do is to be able to convince investors that you can do more with less. Fundamentally, right now, this means that having really strong unit economics that Joe alluded to earlier, especially in later rounds, and then showing that those unit economics are both repeatable and scalable. And one of the ways to do that really is to focus in areas where you truly do have product market fit before diluting your unit economics in adjacent verticals or adjacent markets or adjacent product areas. A couple of other things that you can do to drive valuation higher. Number one is just competitive tension, right? The more interest you have, the more term sheets you have in front of you, the better you are in a position to negotiate. So that's something that you could do through networking, getting your story out, just being, having a little bit of a higher profile. And then the other piece, if you're looking to trade off dilution and valuation, is deal structure. The more terms that you're prepared to give to an investor that are investor friendly in nature, the higher the valuation they're likely to ascribe to you. Now, there's all sorts of potential complications with that down the road, but it's certainly something to consider, especially in this market.
Yeah, I was going to say there's sort of three in my mind. It's just echoing what Daniel said, maybe slightly different point of view, is that, yeah, you can have, ultimately, your valuation is going to be market driven, but it's going to be adjusted for growth. So if you're going through a period of high growth, that's maybe a really good time to go after money. The second is to get as many term sheets to the table, as Daniel said. And the third, I would say, is to know when you've got some leverage. I mean, high growth being some leverage. But if, for example, you're going to supplement, your capitalization equity with debt, for example, you got to know when you've got some leverage on the banks, and you probably don't have much. But here's when you do have leverage on the banks. You have leverage when you're going to be raising capital. The banks love the deposits. And you've got leverage on the bank if you got a wealth relationship, in your company with one of the banking entities. They will move hard to service, to make those clients happy. They'll work hard for your deposit. So if you're a young company heading out without, and you're looking for bank debt to bridge you to some future equity round, good luck with that. You're gonna be wasting your time, a lot of it. But if you're looking at term sheets and you've got an equity, term sheet, and you got a deposit to dangle, and maybe you got a wealth relationship with one of the banks, you've got some leverage there. And, it's good to roll those things all into one sometimes. And I'm not telling you to take down a lot of debt. What I'm telling you is, if you can put a line of credit in place alongside of your equity, so you've got access to that money when you need it, it's a good time to think about doing all those things in parallel. If you got the bandwidth, folks will work hard to put that together for you.
That's great. Really strengthen your position. And then I know earlier you mentioned, obviously you work with a number of bootstrap companies as well, Daniel, you were saying. And I just wanted to kind of talk a bit about equity. So obviously equity is typically at play when you're looking at funding. For some founders, they prefer to bootstrap or non-dilutive capital options. So, can we talk a little bit about what considerations founders should be looking at when making those decisions regarding equity? And Joe, do you mind if I come to you first on this one?
Sure. So your equity partner is your new spouse. You want to make sure you choose wisely. Valuation is just one of many factors, obviously. And if you're, lucky enough to have a couple of offers, you should do due diligence. They would expect no less. And so I would say that probably there's experience with several hundred different funds right here in the Lower Mainland. There's many entrepreneurs. They love telling their stories. We can network you into them. So I would just say do your diligence on whoever you're inviting into your tent. Once they're in, they're going to want a board seat. Some are going to want to have a say. Some will have rights to assert at different times in the future. You really got to understand the dynamics of, if everything goes smoothly, it's all great. There'll never be a problem. It's when things start to go south, you want to know how those folks are going to behave, and who's got rights to assert and who's got a history of asserting them. So it would be nice to know those things. But Daniel would have way more experience than I do, even in that area.
Daniel.
We do have a blacklist.
Yeah, us too.
So, I mean, bootstrapping really is, it's a luxury that I don't think every company has. But if you are in the fortunate position to be able to make a decision between bootstrapping on your own versus taking on some equity, I think in addition to fit, one of the other things that you'd want to consider is the value add from the potential equity investor. So, what you want to be able to do is look beyond just the money or the capital. How can this investor help me accelerate my vision? Can they get me into the customers that I'm looking for warm intros into? Can they help me think about a corporate development strategy? Not every entrepreneur is an expert in M&A, whereas some of the growth equity and private equity firms are. And so if becoming acquisitive is something that you want to explore and you didn't have your own in-house M&A team, which most companies don't, then it might be worthwhile going the equity investor route. Equity investors, depending on who they are, can also help with sourcing talent, at a global scale for you, bringing value add board members. And so those are, I think, some of the considerations you'll want to make if you've got the luxury of deciding between bootstrapping and taking on a partner.
Yeah, the really good ones come with, those teams internally. They've got an HR team that spends a day a week, with each one of their portfolio companies. They've got a customer success team. You probably don't have one yet. And they can layer that on. The bet they're taking is that they can steepen your customer acquisition, curve out of the gate and create their own IRR, immediately on the investment by improving your motions. So, and many of them are great at it, but not all. And so, you want to diligence that carefully.
That's great. Well, we've got through my ton of questions, but we do have a few from the audience to go to. So I'll first look to Patricia, who has a question here regarding cap tables at an early round, around 5 million. Her question is, what kind of appetite is there now for investors to take some secondary shares, take some shares off of founders who own majority of shares?
Well, I'll rip at that one first. Is in the not too 20 years ago, the answer to that was roughly zero. You'll get out when we get out was kind of the flavor of, when I first got into the game. In the more recent past, the appetite's been huge. It allowed a whole bunch of funds to move downstream into smaller financings, but still write bigger checks, right? And they were able to take some maybe not useful or, some folks off the cap table that really weren't that involved anymore. It created fundamental, win-win on both sides of the equation. And I would say more and more, and I find this quite an enlightened view that the private equity folks have, and even the banks will participate in a secondary to a minor extent if the private equity folks are playing in it, is it's really risk, aligning to put some money into the genes of your founding team, into your management team, so that they can really go for it. Like it was really one side of the mouth saying, on the private equity folks going, you got to go for it. If we're coming in, you got to go for it. And the founders on the other side going, I got one bet on the table and I'm going to tell you I'm going to go for it. But quite frankly, I can't totally go for it or I'm on the street, if it fails. And so, providing a liquidity event for the founders in the early stages, a small one, not one that gets them rich, but one that, aligns their risk appetite to their new investors. Yeah, I think is a wonderful thing. So there is still an appetite for that, I would say, Daniel.
Yeah, no, I'd agree. Maybe not at the seed stage, but certainly beyond that.
Right. The next question we have in the chat here, maybe I'll come over to you, Daniel, on this one because you mentioned it earlier, but how do you balance the dual track approach? And, are there any risks to kind of weighing out those two options at the same time?
No, they're actually, I mean, in our experience, it's very common, and buyers and investors are very clear. There's a joke our equity capital markets team always tells about IPOs, is that an IPO is a failed trade sale. So like you're maximizing your optionality by going down both paths. You're increasing the degree of deal tension because you've got more parties at the table. And you know what? You're doing the work anyways. So you're leveraging the work that you're doing for one to go and test the other.
Yeah,
So
back when I was a board member, I used to love the dual track because you'd meet all kinds of folks that would become candidates for your board of directors. And you'd always put the following brand on it, right? You'd just say, hey, we're selling anywhere between 1% and 100% of the company. Like we're selling something here, it's just a matter of amount. And so a financing is anything less than 100. And and so it was always a very natural way to reach out to your strategics, to reach out to your, the gorillas in your ecosystem, the real players in your market, and even your competition. It was a great opportunity for your, for your investment banking partner or your senior management team to go engage with folks that might be key relationships, not this year, but 5 years down the road. Like I always loved the dual track for how it set you up in 5 years if you didn't sell the whole company.
Yeah, definitely. And look, I think from a risk perspective, if you're going out to all your competitors and telling them you're for sale, that's certainly a risk if you're not open to actually doing so, because there's some level of information share there. And like if you're going up against, a Microsoft or a Salesforce in your market, and you don't want to share with them that, you're looking at a potential sale, one way to these large companies all have corporate investment arms, and that's where you can start the conversation, which is, hey, we're doing a round. We'd like to see if we can bring in a value add strategic investor, and they can read between the lines.
Yeah. Well, I'll do a shout out to our audience. We've got a couple minutes left if you wanted to drop a final question or two in the chat. I've got one a little bit off script, but I often ask it as we're running these sessions. I appreciated the optimism that we all share that you included in your presentation, Daniel. But do you have any kind of words of advice for the folks on the call today, for startups who are, maybe early on, but have big ambitions? And Joe, any kind of final words of advice?
Me, Daniel, or you?
Go for it, Joe.
Yeah, so many of the greatest companies in the world were started in economic downturns. You go from access to infinite cash to really testing out your operational capabilities. Give me a company with operational capabilities every time. In the long run, they're not subject to the vagaries of the market. They're not subject to what people think, is going on in the market, or, operational excellence is a wonderful thing in every market. So I like these markets. I like these adjusted markets. I think they're going to produce companies that produce, a lot of returns for folks, but more importantly, they're going to produce great long-lasting companies with options on, how to raise capital and what they're going to do eventually as they exit, if at all. So I think it's a wonderful time to be out there, and these cycles tend to end before you know it sometimes. So we'll be back in better times for raising capital. It's still not bad, by the way. I mean, Daniel has excellent numbers on this, I'm sure, but there's still a lot of capital out there available. Everyone's sitting on their hands a little right now, wondering what's going on in their current portfolios. Everyone's licking their wounds a little bit on some of their higher burn customers. They're realizing they've got to allocate capital to some of these things, but folks are busy, but investing is going to keep happening, and more of it's going to happen in 2023 once things settle down, I think.
Daniel.
So I'd say two things. One is CAC is a bit of a long game, right? And it's about survival. So do what you need to do to survive. Make the hard decisions now to survive, because markets change, competitive landscapes change, technology platforms change, right? And so while you may have been a tad too early for the market today, you may not be 12 months from now because of some enabling technology. And so just survive. That's one in a tough environment. And then two, for those going out there and get venture money now, no is not a bad thing. You know, hearing a bunch of no's is not a bad thing at all. In fact, you should be more concerned if everybody says yes, because it means the idea is too obvious. And, and you're going to have dozens of competitors all raising money to chase the same idea.
That's great.
Some of the best ideas are counterintuitive and counter. I mean, think about Airbnb, Uber, right? Yeah. Hey, let's, low key break some laws and build a market around it.
Inflate a mattress in your living room. That's a business. Yeah, who would have thought it?
They didn't get a lot of yeses.
Yeah, until they ran into Horowitz, of all people. He thought that was a great idea. Anyways, Erica, one other thing I was going to say, just again, back to the debt side is, earlier stage debt than us exists out there. It's super simple. You need to monetize your shred, to make a couple of payroll payments. There are things like that out there. Your lawyers can connect you up. I can connect you up. There's all kinds of shops doing, that are very knowledgeable doing specialty debt underneath the major banks. So the major banks are not your first stop usually as an early stage company.
That's great. Well, I think this has been super enlightening, and we're really pleased to have had two fantastic minds come and join us for the session.